Hey guys, so I wanted to talk a little bit about how to evaluate companies without having actual numbers, because right now what we have in the marijuana industry is we have a lot of companies who are in the process of getting set up, getting everything ready for legalization, but you can't really judge them by their numbers, so you need other things to judge them by. So, for example, Canopy Growth, you have some numbers, but the numbers don't really tell you much. You're not really paying for the $20 million in revenue that Canopy Growth had or whatever they had. What you're paying for is the $100 million or $200 million that they're going to have in a year or so from now. That's what you're hopefully paying for, and that's what everybody's paying for, and everybody understands that. So how do you judge the companies without actually being able to really look at the numbers and compare much? Because the numbers right now, they don't really mean that much. They're nice to look at, but they don't necessarily paint the whole picture. So I want to talk a little bit about that. I am going to be talking a little bit more in abstract principles, so just take those and apply them to companies. But I think this is useful, and I think that it should be an interesting discussion. Okay, so the first thing that I want to talk about is management, because the management of these companies is very important. If you had the option between buying into Canopy Growth, Aphria, or Aurora, and you knew for a fact that one of their management was excellent while the other two were just okay, you would probably buy into the one that had excellent management, because the management in the long run is very important. So to give you an example, let's say that let's say that you met Steve Jobs, but you didn't actually know that he was very successful, right? So you met Steve Jobs before he was very successful, had like $10.2 billion net worth and all of that stuff. It would actually be very difficult for you to be able to judge Steve Jobs, because to give you an analogy, like if you met a savant, for example, who was very, very good at math, you would not really be able to judge that guy on his like prowess in math. You would be able to judge that guy as a person. As a person, you might not like him very much. Like you might have not liked Steve Jobs that much as a person, but it's very difficult to actually judge people based on what they're very good at, because you're not as good as them at it, so you can't really judge them for it. So in math, for example, if you know a savant who's very, very good at math, you can't really judge him because you don't know, like at a certain point he goes beyond what you know with math, and you don't know if what he's talking about, if it would take you 5 years to get to the point where he's at, right, in terms of your knowledge in math, if it would take you 5 years to get to the point where he's at, or if it would take you 50 years. So if you don't know a specific knowledge, and when it comes to management, like the experience the management has, the insights that they have in the industry, it would be very difficult to judge them. So Steve Jobs, for example, very good at technology, very good at programming and all of that stuff, but not very good at a lot of other things. So he took alternative medicine, which is debatable if it actually shortened his life and got him killed. But like if you judge Steve Jobs as a person, nothing particularly impressive. Not perhaps not the most likable guy. If you look up some of the stuff that he did, he had a temper and stuff like that, but very, very good, because we know that he was very successful because he actually proved it in the market. But without having the proof, without having the long-term success, you can't really judge management. So it's very difficult. So that's a point that you want to be able to try to evaluate, but it's very difficult. So you need to know your limitations. But if you do understand something about management and you want to try to apply it and you want to try to figure out which management is better, it's definitely a very strong point for you to take a look at. So the next thing that I think that you should look at is the product that the company is offering, is that product easily replicatable? So if a company has a product that is very difficult to replicate, if they have a unique product, then any imperfection within the company, any sort of waste or anything, it's not going to be as detrimental to the company as a company that has a product that is easy to replicate. So to give you an example, Snapchat has a product that's fairly easily replicatable. So their social media thing, it's fairly simply replicatable. I mean, their competitors have replicated pretty much exactly what Snapchat has been doing. And the idea that Snapchat could stay alive for quite long, being valued at $18 billion, when their product is not really that unique, fairly difficult concept to rationalize, right? And when we talk about marijuana companies, you could apply the same idea, but it's a little bit more complex than that. So marijuana is fairly easily to replicate. I mean, you could grow it fairly easily, but there's a little bit more to it than that. You have regulations, you have tariffs, you have licenses that you need to get, and you have a bunch of different things that you would actually need to set up before you could compete. And it's going to be a while before all of that happens. You also need countries to legalize it and all of that stuff. And an argument that you'll probably hear if you go at the forums, if you go at the Reddit, is that, when talking about the Canadian companies, people will say that if some of the South American companies started to compete with the Canadian companies, they would drive them out of business because the South American companies would be able to grow marijuana in their environment for cheaper than it would be to grow it in Canada. And that is partially true, but then if you have to take in quality, you have to take in regulations, tariffs, there's a bunch of different things that factor into these markets. And the companies that are the most likely to be competing with the marijuana companies are going to be the tobacco companies. So a company like Philip Morris, at some point in its life, at some point in the future, it will probably want to get into the marijuana market. But here's the thing. So if you're Philip Morris, who made $7 billion in profit last year, if you're Philip Morris, you have two options. One option is to go into the marijuana market and start everything from scratch. So you could go into the market, you could get all the licenses, you could get everything, and then start from scratch. And your team that currently runs Philip Morris, they probably don't know that much about marijuana. They know a lot about tobacco, but not that much about marijuana. So they would have to start from scratch. They wouldn't know that much about the industry. So they could take that route, or they could take the other route, which is to buy a company like Canopy Growth. So they could take like 2 quarters worth of their profits and buy Canopy Growth and then still have a bunch left over. And I think that the second option is much more likely to happen. And if it does happen, then pretty much all the shareholders of the company that's going to get bought are going to be fairly happy because Philip Morris will probably pay a premium. So I don't think that it's very likely that a lot of these companies are going to be experiencing heavy competition from foreign countries or from companies like Philip Morris. They might at some point in the future, but it's not anytime soon, so they should be okay for a while. And the last thing that I think is very important to consider is the size of the company. So when we look at the Canadian marijuana companies, the size of the company is quite important because the bigger companies are going to have a much easier time specifically dealing with regulations. They also have the first mover advantage, and they're going to get a lot of free advertising. So for a company like Canopy Growth, dealing with regulations, it's going to be much easier than a smaller company that does not have the resources that Canopy Growth has. So for example, Canopy Growth, they have their Germany division. So they have their Germany subsidiary, Spectrum, kind of like the internet company, but Spectrum Cannabis. This is their logo. They have that company. If you're a smaller company and you want to get into Germany, like if me or you started a company and we wanted to work with marijuana and we asked Germany to get a license for us to be able to grow and sell there, it would have taken much longer than it took Canopy Growth to be able to get that license. Bigger companies just have an easier time with dealing with government regulations and kind of getting past it because they have more money, they can offer up more money to speed up the process, and just generally they have more people are more aware of them and they have more influence. So for a bigger company, when you have a heavily regulated industry such as marijuana, it's going to be easier to be able to get their licenses faster and all the regulations to be able to apply less to them to a certain extent. So that's going to be good. They're also going to get the first mover advantage, which is obvious. And companies like Canopy Growth are going to get a bunch of free marketing because people are going to be talking a lot about them whenever this comes into the news and all of that stuff. So it's quite advantageous to be. I have this like little picture, but it's quite advantageous to be a bigger company in this industry now. Some of the price for that is priced in. The bigger companies are more expensive than the smaller companies because people do understand this. And whether or not you are willing to pay the extra premium for this is up to you. In the long run, I think it's worth it because the bigger companies are going to be significantly better off than the smaller companies. They're going to be able to access markets that smaller companies are going to struggle with. Like Canopy Growth, it's already in Germany, it's already getting set up. The smaller companies are going to struggle with that. Of course, there are going to be smaller companies in Germany that are going to be competing with them, but again, it's easier for a company like Canopy Growth to just take a bunch of resources, get a license passed, and then dump all of those resources into production and just be up and running and efficient much faster than a smaller company. So in those scenarios, that's going to be multiplied in the long term. So in the long term, like if Canopy Growth sets up half a year before a smaller company in like a new market, that half a year is going to provide Canopy Growth with more of a market share, and in the long run, that's going to get multiplied. So it's a fairly big advantage, and those three things: so the size of a company, the management, and whether or not the product is easily replicatable, and how exactly the dynamics of the product are going to be playing over the next few years. So take those principles, think about them. I think that they're fairly useful to think about. It's definitely stuff that you want to consider when looking at these companies, especially if you're going to be investing a lot of money into them and leaving them for several years. It's worth it to just go around and take a look at these different things, and I think it should pay off. So let me know if this helped. I don't know how useful these are, but I thought this was something interesting to talk about because I haven't really seen this talked about that much in the forums or on the Reddit, and I don't know, I think it's interesting. So let me know. I might upload more of these in the future, although I did kind of talk about the majority of the stuff that I wanted to talk about in this video, but that's that.